Hello and welcome into the KE Report. Chad and Corey here, getting an update from Sean Brodrick, editor of Wealth Megatrends and contributing analyst to Weiss Ratings Daily. And Sean, we always enjoy these segments with you where we take a deep dive into the markets and look at a number of different sectors. I guess just kicking things off today, I want to throw it over to you more broadly. As far as the patterns we're seeing in the general U.S. equity markets, we've seen some of the money come out of the mega cap tech stocks and rotate into the small caps. They went on a blistering run the last week or two, and it seems to be getting in front of some of the macro trends as far as anticipated Fed rate cuts and a look at just sectors that have been beat up that maybe could run like an Nvidia stock and run. What do you make of the move and the money rotation you're seeing in the U.S. general equities?
Yeah, it's really kind of a confusing time in the market for me. I mean, we have these short-term trends that don't really lead anywhere. Now, that said, I like the rotation into small caps because many of the big cap tech was overvalued or seemed to be by a lot of metrics. So I am fine with that. Those are the kind of names that I have been looking for, and I'm looking more for those kind of names now. But when I hear things like, say, the Trump trade and like stuff like that, I just shrug. There is no Trump trade as far as I can see. There is anticipation of what Trump might do when he gets into office. But remember, he has to work with Congress. So will his plan to replace the income tax with higher tariffs get through Congress? That seems like a non-starter for me. And we hear that, for example, Trump wants to boost oil production. The U.S. already has the highest oil production ever. More oil production would just mean lower oil prices. And I don't believe that the CEOs running America's oil companies want that. They care more about profits than they do about production. And so we have seen people say that's one reason oil prices are down. I don't think there's any connection there whatsoever. The same thing with gold. Gold is up today. That's nice. But the so-called Trump trade is that Trump's supposed to put in these huge tariffs, which would weigh on the US dollar. And yet the US dollar is up even as gold is going up. So there's a lot of disconnects in the market. It's a very confusing time. I'm not going to complain too much. We took some really stellar gains, including triple digit gains. And I am putting that money back to work, but I'm being very selective about what I buy now because a lot of things trade with really no conviction.
John, let's focus a little bit more just on that rotation into small caps because it has been, in a way, explosive. I think just this month, the IWM is up almost 10%, a little bit off of still its highs from this month. And it's not so much on the Trump trade. I think it's more on this rate cutting trade for the Fed going to be cutting rates again sometime this year. It's something we've talked about ad nauseum for the last couple years. What else benefits from this general trend where we aren't just seeing the Fed who's going to be cutting rates, other central banks around the world cutting rates? Where do you see opportunities?
Well, the two obvious opportunities are in regional banks, which have really been hit hard by high rates because people can't afford the loans they make. There's that. And also home builders, housing generally, real estate. I mean, those are the things that will really benefit from lower rates. And we're already seeing that priced in. Some of the housing stocks I follow, and in fact, I'm making a recommendation in housing for Super Cycle Investor this week. Those are doing very well. And that's basically, as you said, that's a rate cut trade. Those are the two obvious ones to me. Also, gold. Now, I don't think that has anything to do with gold rallying now. There have to be other forces at work besides anticipation of a rate cut by the US Fed. That can't be the thing driving gold, a global commodity, higher. But that should help gold longer term if interest rates go down because gold pays no interest. And so as rates come down on bonds, the old theory is gold starts to look better. So those are three ideas for you: regional banks, home builders and real estate, and gold.
Well, Sean, we had talked a little bit before recording today about the rotation some people are anticipating out of the growth, the tech stocks and even the small caps and into some of the value sectors like real estate. Some other people have noted healthcare, even in some industrial stocks that have been maybe beat up in the past that are looking a little peppier. And I think gold would still fill that value trade as well. What are your thoughts on some money rotating out of growth and into value?
Yeah, well, in fact, my last trade for Supercycle Investor was a small cap healthcare stock that's quite a value stock. So I can understand that completely. And I don't want to put everything in healthcare right now, but I can see the potential for that. And I can see the real attraction of value when people are confused about the markets. I'm feeling the lure of like value stocks in my own portfolio right now because if I'm not really sure what's going to happen to the market, or I should say to how the economy is managed after the election, one place to hide out is value. And value's been beaten down. I mean, there's some extreme value in value right now. So you can get a stock that's growing nicely and maybe not the super growth of a growth stock, but still growing decently. And it pays a nice yield. It's a good place to hide out. I think I can't be the only one thinking this. So, yeah, I think value stocks could look a lot more attractive going forward here, especially at the beaten down valuations that whole group has right now.
What about dividend stocks then? Argument being, if we have lower rates, if people can't keep their money in money market funds, safe investments, earning some sort of cash flow, does that money flow into some of the higher dividend stocks?
Well, I consider dividend payers to be value stocks anyway. And in fact, when we launched Wealth Megatrends, my whole thesis there, which served us very well when the market crapped out in 2022, was to get excellent value stocks that grow their dividends. And they've never found a way to market that. So I had to kind of branch out on that because people don't seem to care about dividends. I care. I love being paid by the stocks I own. A stock that will pay me to own it and has a growing business and also grows that dividend because of its growing business seems perfect to me. And yet it's very hard to compete, at least in marketing copy, with some high flying tech stock that seemingly prints money out of thin air. That's always the problem. But I can see stocks that pay nice dividends, but importantly, grow those dividends being very attractive. Dividend growth is important because that's one of the metrics that those Wall Street firms that invest in dividend paying stocks look for. They look for stocks not that just pay dividends, but grow their dividends. That's why they tend to shy away from, say, companies that own a lot of oil wells and therefore pay a huge fat dividend. But then when the price of oil goes down, the dividend goes down. That's not what they want. They want a nice steady grower that pays a nice dividend and will pay an even bigger one in the future.
Yeah, great point, Sean. And I think a lot of the value stocks, to your point, are the dividend-paying stocks to begin with. Some of the consumer staple household names would be in that category. Some of the healthcare, even utilities, and even energy companies have pretty nice dividends. Now, you always have had a theme running in the background as a megatrend of the reindustrialization of America. Do you see that changing at all? Do you see any opportunities in that sector, which kind of falls into materials and commodities?
Well, we actually took a bunch of gains in our reindustrialization stocks starting back in, I want to say April or May. We took like a string of them, but I'm starting to ease back into them. One reason we did that is because the stock stalled out because investors knew that it was going to be very hard to get any earnings growth compared to the tremendous earnings growth they had last year. That's true. So what I'm looking for now specifically, and I had some charts that I put on Twitter showing how, for example, factory building is going in the US right now. It's just enormous. The amount of like factories being built in the US. Yes, the US is re-industrializing and it is huge. I mean, we have seen construction spending on manufacturing triple since January 2020. So if you can find a company that feeds into that, either it makes the equipment that's used, maybe it actually builds the places, maybe it installs HVAC in those new factories, whatever it is. I mean, they can do extraordinarily well. So what I'm looking for is to get back into some of those stocks and also new stocks in the industry that we didn't own before. But I'm looking for those that are able to grow their profit margins. And there are some that are. And they're doing this mainly by cutting costs. I mean, as I said, it's hard to compete with the previous growth that we saw before. But one thing that people should keep in mind is that in the past couple of years, we've seen 3 important spending bills pass. We had the Infrastructure Investment and Jobs Act, $1.2 trillion, the CHIPS and Science Act, $280 billion. Both of those do things like build factories, build roads, build bridges, huge. And then we have the Inflation Reduction Act, and it's an odd name for that bill. I mean, but it's still $579 billion. And one of the things it does is it does invest in things like infrastructure, very specific types of it. And so that's also just kind of moving things along, getting new factories built, stuff like that. So this is a tremendous amount of money that's going to be spent in this whole sector for years. I mean, they already have the outlays, but they can't spend it all at once. It takes years to spend that kind of money. So if you can find stocks that are leveraged to the reindustrialization of America. Now, we already know about stocks called industrials. These aren't industrials per se. I mean, they are part of that larger group, but they're industrialization stocks. They are part of the building process. So if you can find those stocks, and if they're increasing their profit margins, I think that's a place to be for at least the next 6 months to a year. Could be much longer. Those are stocks that we've traded in and out of, and like Resource Investor, we've done very well with those, and I hope to keep doing that.
Sean, how do you, if that's your narrative, that you're looking for maybe some of that free government money or some sort of cheaper cost of capital for some of these companies that is available, but it's hard to determine when and if they're even going to get it? How do you trade in and out of these stocks to make sure you don't miss out on a potential big move?
Well, luckily, I have access to a Bloomberg terminal, so I can see when analysts are like raising their earnings estimates on companies. I mean, it's not like I'm calling every CEO in the country, but I can see what people are thinking about what these companies will do. You can also get clues in the earnings calls because they'll say, we had a tough quarter, but we're really cutting costs this next quarter, or else we had that huge outlay in the last quarter, but we won't have anything like it in like this quarter. Those are companies that are going to expand their profit margins and therefore increase their earnings. Those are the kind of ones I look for.
Well, Sean, one other sector that I think we need to touch on, and that is the uranium sector and the nuclear power needs and the energy needs that the country has and that the world has. How are you looking at the uranium sector?
Yeah, well, I mean, I think that anyone who isn't paying attention to uranium right now is really missing the boat. Now, we saw uranium prices surge. Why did that happen? That happened due to the pandemic, which caused the actual, and I should say temporary, closure of uranium mines. And also the whole supply chain around the world really got messed up. And that caused kind of a panic among utilities. So we saw some real buying. That was good. But that peaked in around January and February of this year, and prices came way down. They went from 105.50 to like 84.50. That's the spot price of uranium. Now, the long-term price that utilities buy under is lower than that, but it's recurring. It happens over and over again, and it tends to follow the spot price up, though not without those big magnitudes of moves. So we saw a big run up in the price of uranium and in uranium leveraged stocks. Then things really started to drift down since around early June. Uranium has actually been in a price in a tight range, and uranium stocks have gotten no love because since the price of uranium isn't moving, the hot money has moved on to somewhere else. However, 3 things to keep in mind. A lot more nuclear power plants are being built. 62 are under construction around the world. There are 440 nuclear power plants operating now. 62 are being built. 28 will come online by the end of 2026, another 110 nuclear power plants are in the planning stage, and 343 new nuclear power plants are proposed. That's a hell of a lot of demand coming down the pipeline. Also, due to the fact that Russia invaded Ukraine, and generally Vladimir Putin has the personality of a moray eel, we don't want to buy as much uranium from Russia as we do, because you can't just mine uranium, you then have to process it into nuclear fuel. And so all the uranium that's mined in Kazakhstan and other uranium mined from Russia that gets processed in Russia to nuclear fuel, as a result, Russia provides 30% of global uranium conversion and 46% of enrichment. So the US government doesn't like that, doesn't like being dependent on Vladimir Putin for its uranium. So we've seen a number of steps taken by the US government to wean the US off of Russian nuclear fuel supply, and at the same time ramp up domestic uranium production. That's very supportive of these small companies, small processors. We're seeing a lot of stuff happening there. And so I think that's really, really good. And the third thing, just this month, Kazakhstan, which is the world's largest uranium producing country, as I'm sure you guys know, just surprised everyone by hiking the uranium extraction tax. Now, initially it's going from 6% to 9%, but then it's going to be graded depending on how much uranium a particular mine produces. And the more uranium a mine produces, it can go as high as 18%. I mean, that's a huge hit to someone who was used to paying 6%. And so what's going to happen is uranium miners in that country will have every incentive to keep production just below the next tax bracket. And they have a lot less incentive to go find new uranium mines, or I should say, new deposits to add to existing mines. So that's going to really damper any upside from Kazakhstan, which was kind of a thing hanging over the market, because when they really turn on the taps, and for those who don't know, they run sulfuric acid through the ground to leach uranium out of it. That thing must be an environmental nightmare. Anyway, so there's much less incentive for them to do that, which really takes off the threat of future supply. So you look at it, I mean, we might see a surplus in global uranium supply sometime in maybe late 2025, early 26, but then there's going to be a yawning gap, a chasm opening up between demand for nuclear fuel and what the existing mines and the proposed mines can actually produce. How that gets fixed, I don't know. I assume we'll find more Western deposits and bring those online. But one way it'll be fixed in the shorter term is through price. And so you put all those things together, and yeah, I think uranium's going a lot higher and uranium stocks are going a lot higher as long as they can stay in business. And this is important. Until like 2026 or so, they should be fine. Now, they might have to raise funds, but I have a list, which I'll be showing during my presentation, of all the near-term projects that are going to come online around the world. And those are the companies I think really could ride this trend, ride this tidal wave of demand that's coming. It isn't going to happen next week. It isn't going to happen next month, but it's coming, and utilities think longer term. They are going to see that coming. So keep that in mind. That's why I'm just so excited about this whole industry, and why I think that there could be some extraordinary profits made in the uranium industry going forward.
Well, Sean, we definitely appreciate you sharing kind of a sneak preview of some of the key bullet points you'll be going over, going through the projects that are near-term development and coming online, where the action is in the sector. And Sean, we always appreciate you coming on the KE Report, sharing your ideas with us on the markets, on the different sectors that have your attention, and looking forward to our next conversation.
No, thanks very much. It's always fun.